I'm really pleased to be able to welcome you all today. For those of you who may not be aware, Women in Securitisation, or WIS as we refer to it, has been around since 2012 and is a standing ASF subcommittee which aims to provide women in the securitisation industry with networking opportunities, awareness of issues that affect professional advancement, and assist with the growth and success of the securitisation industry, particularly as it relates to the contribution that women can make. RBC Capital Markets is a big supporter of WIS, and we have hosted a post-budget luncheon in our offices over the past few years, but of course we can't follow the same format today. Notwithstanding this, I'm delighted to introduce our presenter today, Su-Lin, a Managing Director of RBC Capital Markets and our Chief Economist and Senior Relationship Manager. Su-Lin has led our economics and fixed income strategy team for Australia and New Zealand since 2010 and was head of AU research and is part of our global strategy team with primary responsibility for formulating and presenting RBC's Australian and New Zealand macroeconomic outlook, cash rate view and bond yield forecasts. Su-Lin is also a champion of women in our industry. She sits on the board of Women in Banking and Finance, as well as being an ambassador for the RBA's Women in Economics initiative. So without further ado, I'll hand over to you, Su-Lin. Thank you.
Thanks very much, Jen, for that introduction. And thank you, Andrea and the team here at ASF for hosting today's function. It's turned into one of my favourite annual events. And while it's a pity we can't all meet, we normally have some very interactive discussion around the table. We could still try and do it virtually through the Q&A function and hopefully get a good discussion going today. So what I'm going to do, and let me just pull up these charts and make sure we are all good with them, is to start off with a bit of an update on our thoughts globally and drawing really on some of the work from my global team. As always, I think it's important to get a sense of what the global backdrop is. Australia, a small open economy, highly leveraged to the global growth cycle, and what's happening has enormous impact both from an economics perspective, geopolitics, and obviously through markets as well. So I'd like to try and set the global scene and then delve into the Australian outlook, where we're at, where we think we're heading over the rest of this year in 2021, and do it very much through the lens of the budget that was delivered earlier this week. There are a number of key initiatives in that budget. There's several measures that have all had an impact on our thoughts around the consumer, around housing, around business investment, with implications for securitisation. So very much our views have evolved since Tuesday night and some of the announcements that were delivered then. But let's start with the global backdrop. And I'm just going to make sure we can do these, perfect, these charts. Hopefully everybody can see them. Please shoot through a message if you can't. So where are we in terms of the global picture? I think a good place to start is, and to get a sense of where global activity is at, is with the most recent and very timely PMIs. So these are the Purchasing Manager Indexes. We have most of them for most countries for up to about September. And the easiest way to think about them is a number above 50 indicates expansion, below 50 is contraction. And it's pretty clear from a couple of key countries that we've plotted here that there was obviously a sharp contraction in activity through a lot of March, April and a lot of May. And we've also seen a reasonable bounce back since then for much of the third quarter, very much as, and in most of the developed world, very much as restrictions were eased, there was a bit of pent-up demand, and obviously from a huge amount of stimulus right around the globe. So some of these bounces look quite V-shaped and very consistent with, you know, after a very big contraction. Most of the developed world contracted about 10% in Q2, a clear recovery in activity. The pattern of the PMIs and what they show is mirrored really in a bunch of the other high frequency data. So we see a similar pattern in terms of retail sales, confidence, housing numbers, and employment. I think what's interesting now, and you can see the last couple of prints are all getting a little bit messy in this chart, But what they show as well is probably two key messages: that the initial bounce back and momentum is easing, and it's a fairly uneven recovery. And that in part reflects, I think, developments on the health front, where we're starting to see, we've started to see second waves, renewed restrictions in parts of the world, and that's starting to have an impact on the data, and markets definitely uncertain about the sustainability of this bounce and recovery. So if we look across a number of the key markets, China, that yellow line that went in obviously earlier, came out sooner. The story there is quite encouraging. That index level, that yellow line, is back above pre-COVID levels. The recovery is reasonably broad-based, and so particularly for Australia, that's a good sign for this region. Other parts of the world, and particularly the developing world, it's a little less clear. The US is that black line on the chart, and there the bounce has been very strong. The recovery as well, pretty decent and remarkably resilient. The UK is losing momentum, not surprisingly, as this second wave is coming through, and Europe as well, a key laggard here. And in Europe in particular, what we do know is that this pandemic has exacerbated the north-south divide, and that in part is a reflection of the southern part of Europe, very heavily dependent on tourism. So the message is fairly clear, I think. The bounce has happened. It's now a little uneven, losing some momentum. The key really is what happens, I guess, in the next quarter and into 2021, particularly as some of these restrictions step up again. So worse behind us possibly, but a fairly still challenging outlook ahead. I guess the other thing we try and point out when it comes to talking about growth is that the focus, I guess the way growth is reported, the focus on percentage changes can be a little bit misleading as well. So we're going to see some big numbers in terms of Q3 GDP, big bounces in activity from a percentage perspective. But what's important here is that it takes quite a long time, usually after that degree of contraction, to recoup to the level of output pre-COVID. And in most countries, with the exception of China, possibly the US, it's going to take probably through to at least 2022 for output to be fully recouped from the big hit from the first half of this year, despite some percentage increases that look pretty impressive all round. So I'd like to, as I finish this global picture and setting the scene, just draw on a couple of interesting views from our global team, and that ones that are also maybe a little bit different to what you may have heard and what markets have been talking about. So in the US, clearly everyone's captivated by the upcoming presidential election. And I think what's interesting, the team point out there, is the polls have shifted and they've moved around. Clearly, Biden is in front. Increasingly, I guess, and the team has talked about this for some time now, even when the polls were moving around, what happens in terms of not just a Biden victory, but also a clean sweep. So the Democrats then regain the Senate and have control of both houses. And also the third thing that's interesting is who takes the key US Treasury Secretary role, because that's quite important, clearly, for the economy, markets, direction of policy. And that will be a really important one. The front runner at the moment is Elizabeth Warren, who is much more of a proponent around much higher taxes, greater regulation. It would be a pretty tough US Treasury Secretary for markets, I think. So that's an interesting angle to think about as we get closer to November 6th. In the UK, the team there remained pretty downbeat. The UK has multiple challenges. It was one of the weakest economies by far in Q2. So while most of the developed world contracted about 10%, the UK contracted 20%. The Brexit situation clearly uncertain. There is a deadline for this withdrawal agreement and a lot of uncertainty. So interestingly, our team have a fairly non-consensus view for the Bank of England to move into negative territory, negative rates in early 2021. In Europe, again, a fairly cautious approach, but here interestingly, they point out some upside through the European Recovery Fund, a quite unique fund with a lot of firepower that will actually issue and draw on European money. And so for particularly the southern states that I suggested, were coming under greater pressure, that fund will disproportionately benefit those southern states. So possibly some upside when we think about Europe, we worry about downside risks and in particular structural challenges. So that's worth keeping an eye out on. And in terms of China, again, the recovery there, as I said, reasonably good. In particular, is starting to benefit or will benefit from the global recovery. And you can see on this chart here, the bounce back that we're getting in global trade. That is particularly positive for global manufacturing and for China. That for us is a reasonably encouraging sign. And you can see it through some of the key indicators in Australia, particularly on the external sector, on the exports and iron ore front in particular. So that's a quick snapshot of the global picture. Some of maybe the slightly different and interesting views from our global team that I think bear watching in the months ahead. If I turn now against that global backdrop and focus on Australia and weave in, I think, in particular, some of the key measures from the budget on Tuesday night. I'd say in a snapshot, Australia, so far, and really for a lot of this year, has probably fared better than most developed markets, both from a health strategy as well as an economic perspective. So the health strategy has generally been better, the economic outcomes, and so far also reasonably good. We have, though, underperformed much of the region. So by Asian standards, with the exception of India, we've probably been laggards. So interestingly, I think Australia sits maybe somewhere in between developed and EM world in terms of health strategy and the economic outcomes. So, clearly we benchmark ourselves to developed markets, and the story, I think, in general has been pretty good in Australia, and that reflects, from our perspective, very much, a health strategy that has been pretty strong right from the start, with some setback from Victoria. What does it mean for our numbers? So we've tried, I think, not to shift our numbers too much in the last 6 months. It's been a really challenging time, as you can imagine, to have economic forecasts. I think the themes behind the numbers are probably more important than the actual numbers themselves. For those of you that have heard me speak before, for many years now, we've been pretty glass half empty. We're generally cautious by nature. We've never had V-shaped type recoveries in our profile for this year and next. But what I would say, and I do think it's significant that we've shifted our thinking, is probably in the last month or so, maybe 4 to 6 weeks, we have upgraded our numbers. We think the risks are more balanced, and that despite what has been a lot of negative news for much of the last few months, we would argue that we can see a bit more upside, particularly near term, and we have upgraded our forecasts somewhat. The budget very much is consistent with that. I think it was a budget that really sets the framework for recovery. There was 2 key criteria, and it was squarely focused on boosting confidence and boosting jobs. In our view, it was a very admirable mix of measures that were delivered on Tuesday night, designed twofold to help near-term demand and the unfolding recovery gain some momentum. But it also had measures in there that were designed to boost longer-term growth, to lift productive capacity, to lift productivity, and all of that is really important in terms of a sustainable recovery. So from our perspective, what we've seen is really quite encouraging. The other key point we'd make is that fiscal stimulus, and clearly that lever is being pulled very hard here at the moment, fiscal stimulus in recovery should look different to the depths of recession. So a lot of what we've had to date was really about just trying to keep the economy afloat and trying to plug that hole in demand and income from a big, huge external shock. And that was really how fiscal policy was calibrated for much of the last few months. As you come out of recession and move into recovery, policy should look and smell different. It shouldn't just be about plugging that hole. It should now be calibrated towards trying to incentivize businesses to invest, to spend, trying to incentivize private sector households to spend as well, trying to put in measures, like I said, to lift longer term productive capacity. And from our perspective, the budget did do that. It deserves a number of ticks for trying to get that balance right. And I think it's also been framed with an understanding that while we are coming out, that this recovery is still pretty uncertain. And in particular, we know by the time we hit 2021 in the first quarter, where a number of key income support measures will be pared back and will cease, coupled with some of the the end of the deferrals on key loans, that could be a bit of a challenging period. And I think the budget and the front loading of some of the stimulus has been designed as well, mindful of what's coming up in early 2021. So if I run through our numbers and put in some of our budget assumptions as well, we've assumed for some time a couple of key assumptions: that Victoria does exit its restrictions, and that starts more so in the coming weeks. We are assuming both further monetary and potentially further fiscal stimulus as well. We also assume a vaccine of some sort by around mid to the latter part of 2021, and that the international borders are closed, mostly closed until the middle of next year, notwithstanding potentially some students coming back a little bit earlier. So that's our starting point assumptions. You can see from this chart here that the starting point clearly, Q2 growth was -7%. Like I said, by developed world standards, not too bad, but obviously still pretty awful. For us, Victoria was a setback to the recovery, but it hasn't derailed the recovery. And so while we had hoped for a bigger bounce in Q3, Victoria has taken that down somewhat, and we've pushed the growth more, as you can see in those bars, into Q4 and early next year. And the budget very much has helped in that regard, because we think that in particular around consumption, we are likely to see a boost to activity near term. I think the point that we've made really for the last 4 to 6 weeks as we've turned more positive is that outside Victoria, most of the data has been moving in the right direction, right across the board. You can see it in this chart here, which captures employment by state. Clearly Victoria lagging, but again, the worst looks like it's over from that bottom line. The rest of the states heading in the right direction. When we look at some of the alternative data and we look at the mobility numbers here, again, most other states, the big states, all improving, clearly not back to pre-COVID levels, but we wouldn't expect that yet. And Victoria as well, we think the worst behind. So, that's partly underpinned, I guess, our positive view, or increasingly more positive view. And I think, like I said, the budget adds to that. So there was a couple of big ticket items in this budget, 2 big ones. And the first one was obviously the bringing forward of stage 2 income tax cuts. Now, our original forecast, we thought this was going to happen, but we actually thought it would be brought forward to the 1st of January next year, a time where, as I alluded to, we thought that it may be a bit more challenging as some other income support measures end. The government, I think, has gone a step further, brought them forward and backdated them to 1 July this year. And so, again, I think designed to boost activity, income and activity near term, mindful of the challenges of Q1. We've made some assumptions about, and I know there's been a lot of discussion about, will households actually spend this money, or will they save it? We'd note that it hits very much at lower to middle income, where the propensity to consume should be higher than the much higher income. We also think it is largely a function of confidence in the labour market, and the signs of improvement in the labour market, as well as I think some increasing confidence, and I think this budget is a positive for confidence, should see a little bit more expenditure. So we've taken, we think, a conservative approach. We've done the numbers and we're assuming half is spent, and that does take our GDP up and our consumption up for Q4 and into Q1, as Victoria increasingly comes out of its restrictions as well. I think the other helpful factor when we think about household consumption, which is 55% of GDP. So we kind of really need to get that moving if we've got any hope of activity strengthening up much. And it's the lift that we've seen already in household savings. So from all the stimulus, particularly JobKeeper, that was delivered and started in March of this year, showed up a lot in Q2 GDP and Q2 household incomes. And we saw that savings rate shoot up to that 20% level. In dollar terms, it's about 60 billion. So what is that? That's like 3% of GDP. So it's a big pool of money sitting there. And now again, that may not all get run down anytime soon, but it is a clear buffer at some point. And, much as we often point out, depends on confidence and depends on the labour market. You'll be more willing to run that down a little bit if you feel confident and if you feel reasonably secure. So when we think about the consumer, we can see some positives from this buffer that is built up from the income tax cuts, which we think were definitely above what we were anticipating in terms of timing, and as that labour market improves a little bit more. And so from that perspective, we remain still reasonably positive when it comes to the household. The medium-term challenges are there, though, and we've pointed this out a number of times. When we think about the debt levels, and that shows up in this chart, when we look at what is still fairly low productivity, very low stagnant wages, we know there are challenges for households medium term. I think that what the budget measures do is provide a lift in confidence and near-term support, and we will get that lift in consumption. The question, again, like a lot of the questions I think at the moment when stimulus runs out, and Australia is not the only country where that will happen, is what happens further down the track. And this is where some of the structural headwinds that we've talked about in the past, that's where they emerge, and the household debt story is one of them. Australia clearly, as you can still see, ranks pretty high here. And so at some point, while we expect this lift near-term in consumption, the risk is it moves back to a more pedestrian type pace later in 2021 and beyond. If I move across to housing, we look at housing, as most of you know, from two different angles, from a construction perspective and also from a house price perspective. From a construction perspective, our profile hasn't changed enormously. Residential construction's been declining for some time. It's likely to continue to decline for a few more quarters, bottoming out a bit further into 2021. The fundamentals are a little challenging, and particularly around population. We know that the borders will likely remain shut for some time, and even when they open, it's going to take some time, I think, for the net migration piece to pick up, and that's very consistent with the budget forecasts. On top of that, we know, and the risk is that during tougher economic times, fertility also pairs back, and again, that's very much consistent with the budget assumptions as well. And so the odds are that residential construction activity remains pretty low, despite lower rates and some assistance from the government. From a prices perspective, I think what's most interesting, and you can see from this chart here that we have revised our numbers higher. So we'd originally thought nationwide that house prices would drop about 10% over the course of 2021. We've pared that back to a 6% drop. And we know that some of the resilience is happening from measures that won't be there forever. We've had clearly both direct measures to help the housing market, including, a further extension of the first homeowner deposit scheme that was announced on Tuesday night. So we've had direct government measures as well as indirect through, a bunch of other measures, including JobKeeper, Seeker, and obviously these income tax cuts now. And so we are mindful that there's been a lot of support. Some of it will be withdrawn. But even with that, we'd have to say house prices have proved remarkably resilient all round. And so the better starting point, the fact that there is ongoing support, I think, clearly interest rates remain low, and that's been a key factor as well. And I can pull up another chart. The kind of very resilient house price story is not unique to Australia. We see it, in many other parts of the world, and we obviously pay a lot of attention to what's happening in Canada, given the similarities. And they've taken an even higher leg upwards in terms of house prices. So we're a bit more comfortable now that it's probably going to be a shallower downturn. It's probably going to be more drawn out. It has benefited from some measures that will cease, and I think we may see a little bit more pressure on house prices when that happens in the first half of next year. But the odds are that any lift in arrears and defaults will come from a pretty low base, obviously, and not be as high as potentially thought earlier on. And so that, from a number of perspectives is encouraging, particularly from, I think, a confidence perspective. And confidence is something we keep coming back to. In terms of the business investment side, there was the second, I think, key measure, and I apologise for this very messy chart, but you'll see where I'm going in a second. The other big measure in the budget was obviously the immediate write-down of key expenditure on depreciable assets. And, this is one that will be massively beneficial, I think, for small to medium enterprises. Pretty much all of them qualify. It is a very immediate measure designed clearly to entice businesses into spending on CapEx. And from that perspective, again, it ticks our two key criteria when it comes to trying to boost investment and demand near term, but also longer term. Much stronger CapEx is absolutely key for higher productivity and potential growth. And so for us, that measure in the budget was pretty significant. If there was one surprise for us, it was probably that one, the extent of that measure, and also the time frame through to 2022. So for businesses, even if you are a bit uncertain at the moment, not willing to spend even with this incentive, if things improve over the next 6 months, then that measure is still available, come 2021 at some point. So I think it will go some way in helping on the investment side, which is sorely needed because CapEx was already pretty weak coming into 2020, even pre-pandemic, and fairly encouraging. The key is around confidence, and this is what this very messy chart is. These two measures here are both business and consumer confidence. And I think, what's most interesting is clearly they kind of map really the restrictions and the health side of things more so than the kind of actual economic data. To some degree, they map stimulus measures as well. And clearly there's been a little bit of an improvement of late, generally as the Victorian situation has improved. And I think what will be important is whether we see a bounce out of this budget and levels of confidence move back on a sustained basis to a higher level. And we think there's a reasonable chance that it could do so. We're very mindful there's a lot of uncertainty. Another outbreak, any kind of renewed restrictions would see that set back quite easily. And so confidence is fragile, but that will be really important in terms of actually the measures in the budget getting traction. So for us, that's really key, keeping an eye on both business and consumer confidence. If I turn to the labour market quickly, I think that, again, it mirrors very much what we're seeing in activity space. So, a big hit to employment throughout the course of March and April, close to 1 million jobs lost officially, probably more than that unofficially. And we've seen, though, a pretty decent recovery in the last few months, probably more than we had anticipated. And we have recouped a bit over about half the jobs that have been lost. What's challenging, though, clearly is, and we see it right around the globe, this is a very similar story that we see in most developed labour markets, big hit, pretty decent recovery, and then the pace of job recouping starts to ease and it gets harder and harder. From that perspective, the budget also, for us, got a number of ticks, in particular for measures and incentives to business to hire labour. And so the two key schemes, the subsidy, the 50% subsidy for apprentices, as well as this new job maker credit that's been delivered when businesses hire those that are on the job seeker program, so those that are unemployed, and in particular, and it's designed very much at younger Australians, so under the age of 35, and there is a payment and incentive when you take on those younger workers. Now, again, there's been, I think, some criticism about, well, what about older Australians? They too have been affected, but I think what we would argue is we know from history that recessions generally hit younger and obviously more inexperienced workers harder. It takes them longer to come into the workforce. It sets back their earning potential. And I think in particular, this recession and the nature of the recession, whereby obviously it hit in particular industries like hospitality, accommodation that are more dominated by younger labour, it's been hit harder. And I think it makes sense for some of the measures to be tailored at the sectors that at the cohorts in the labour market that have been hit the hardest. So we think it's a great initiative. I think it will go some way in underpinning some employment generation over the next 12 months. It targets a particularly key cohort in our view. And so from that perspective, it is reasonably encouraging. I think I might just skip a couple of these other charts. All they show really is a labour market that has generally been moving in the right direction. Again, it mirrors, I guess, our comments earlier about when you strip out Victoria, the rest of Australia doesn't look too bad. It shows up in these hours worked measures here that you can see with Victoria, obviously the key laggard, and it also shows up in some of the state breakdown of unemployment rates and underemployment rates. I guess I'll just finish up in terms of the labour market section in talking about just this. For us, there's always been too much of a focus on the unemployment rate, and look, we forecast it and the government does, and it's a key metric, but really it only tells part of the labour market story. And what's much more important in our view is underemployment and underutilisation. And I think the challenge there is Australia came into 2020 with a pretty high underemployment rate. As you can see, it was already above the long run average. It's obviously spiked a long way. It's coming down now, but it's going to take a long time in still challenging circumstances to really get this labour market in much stronger shape. And ultimately, that's the key here. It's driving this labour market, and the focus is driving the action of all policymakers, government, Reserve Bank, even the banking system to a degree, and the measures that they've put in place. It really is all about getting some of these broader measures of the labour market looking better. That high level of underemployment really highlights the amount of slack in the system. And so this picture is not particularly surprising. We're already seeing an easing in wages growth, and that will continue. Again, translates through pretty quickly, as you can see on this chart, to very low inflation. And in particular, the only real line you need to be looking at on that chart is the dark blue line, which is under the underlying inflation rate, which we think risks easing even further, remaining well below the Reserve Bank's targets. So fairly challenging outlook when it comes to wages and inflation. That clearly underpins a lot of the Reserve Bank's actions as well and what it's thinking. I think that when we talk about policy being very much focused on the labour market, it's without doubt, in our view, that it's fiscal policy that should and will continue to do the heavy lifting. It's by far the more powerful tool right now. It's more effective. It's better targeted, as we've seen from some of those measures in the budget on Friday night. And I think importantly for Australia, and the numbers on this chart here look a little scary. Those are the underlying balance, which is the columns, and obviously, the press has been littered with historically large deficits, post World War II type numbers, and that's evident in I think all the numbers and the forecasts. But I guess the question we would pose is, what else would you do here? You need to pull on that fiscal lever. It is the most effective. Standing by and not delivering stimulus or withdrawing the stimulus from a fiscal perspective too early, in our view, would be a far bigger mistake. And Australia is extraordinarily fortunate. It has that fiscal flexibility. If you look at this chart here, Australia debt levels are pretty low by international standards. We came into 2020 with almost a balanced budget, which is not what most of the developed world had. Clearly that has moved sharply negative, but what it means is our debt levels were low to start with, and we have considerable scope. And as I said, our base case is actually that we probably will see further fiscal stimulus if necessary. And one of the glaring omissions from the budget on Tuesday night was no further discussion of job seeker. So it is scheduled at this stage to return to its original level at the end of 2020. We think that that's unlikely, that we will see some permanent lift. And so, again, I think the budget, there is scope for that in terms of our fiscal flexibility. And that I think, while the numbers are big and the debt levels are high, we know net debt will rise over the coming years to close to under $1 trillion, from less than half of that at the moment. The numbers look scary, but the key really is from a comparison perspective globally, and also from a debt servicing perspective. And there, given the level of interest rates, our debt servicing costs are largely stable in the coming years, despite a much bigger debt load. The other perspective I thought I might just add, given where I sit from a fixed income desk, is that, I'm going to just jump to this one here, is that the demand for Australian bonds remains extraordinarily strong, both from the domestic investor community as well as, importantly, from offshore. So offshore hold about 55%, nearly 60% of our bonds. They're a very important cohort of buyer. They continue to be very active in Australian fixed income. This chart here shows you those bars on the right-hand side of the dotted line are all the bonds that have been issued over the last 6 months, the new bonds that have been issued to fund these large and growing deficits. So, a number of new bonds from the NOV 24s all the way out to a long bond, a new long 30-year, the 51s. What those bars show you is the amount of demand for those bonds. So, for example, that November 31, the book size was 66 billion. They actually issued 21. So what it's showing you is very strong demand for these bonds that are being issued. All of them have been 2 to 3 times oversubscribed. They've performed well. We know there is ongoing appetite for these bonds. Australia, for a lot of offshore, ticks a number of boxes in terms of the economy, the transparency, the Reserve Bank, the way they've handled the health, way we've handled the health strategy. And so from the perspective of can we issue, is there demand? From everything we can see, absolutely there is, and it should continue in our view. And so, you know, the fiscal side, like I said, continues to very much be the focus, but we'd also argue the Reserve Bank is part of helping this story. And what I guess we've talked a lot about in really since the start of this pandemic is the increasingly blurry lines between fiscal and monetary policy, increasing coordination between those two arms of policy. And I, you know, extend that to probably the banks being part of that story as well, in terms of, you know, all key policymakers and sectors pulling together to provide the necessary assistance for both recession and, more importantly now, in recovery. So the Reserve Bank as well has been active on this front, as you know. In our view, the Reserve Bank will do more as well. It will do what it can to keep yields low, to keep borrowing costs low, especially for the government as they continue to run these large deficits, both Commonwealth and the states. And so we think that it's very likely we will see further action from them. We expect the overnight cash rate to be cut to 10 basis points, the 3-year yield curve, a 3-year yield target also to be cut to that level, as well as the rate on the term funding facility. So all moving to 10 basis points from 25 currently. Our preference, and we think the strongest arguments and the most compelling case from an economic perspective, is to do it in Q1 of next year, a time where, as I've alluded to, there might be, you know, the economy hits a little bit more of a more challenging patch. The risk is, though, that it happens earlier, that, like the government, we get all the support in early, in part ahead of that Q1, slightly more challenging Q1 period. So we think the bank will do more. I think what's interesting is that that from the perspective of offshore, the view has been the Reserve Bank's been a bit of a reluctant player. I would probably view it a bit differently. I think that the Reserve Bank is at the very early stages of unconventional policy. It has a lot of tools in its toolkit. It's not a super, you know, I think it's taken a while for them to embrace unconventional policy. They never really wanted to go down this path, but they really have no choice here, given the shock to the economy and the need to really get this recovery going. So I think from our perspective, they will do more. It can sometimes take them a little while to get there, but I think we take some comfort in the fact that that toolbox is still pretty large. It's full of a lot of options for the bank, given that they are at those very early stages of unconventional policy. I think what is also encouraging is that you know, I suspect they won't hesitate to use them if we got another external shock or if circumstances demanded. So it is encouraging to see all arms of policy moving in the same direction. We haven't always had that in the past, and I think the message is clear that more will be done if needed. So I might wrap up there and leave some time for questions. I hope that gives you a sense of what we're thinking. We have given the budget a reasonable tick in terms of key measures, both in terms of helping lift near-term demand as well as longer-term potential growth. And I think that's where the difference lies now as you calibrate fiscal policy for recovery. For us, it has meant a bit of an upward revision to our numbers. So we think growth this year comes in probably now around minus 3.7, 3.8%. Previously, that was probably more like a good 4% plus contraction. And next year, we will see growth, we think, lift up to about 2 3/4, closer to 3, which is also encouraging. So I might pause there and open it up to questions.
Given women have been disproportionately impacted by the pandemic, is there enough in the budget for women?
That is a good question. And look, I've done a couple of presentations over the last 2 days and have been asked this question, and I am on record as saying I do think it's a little disappointing from the female perspective, given the amount of money that was distributed through the budget. So there was pretty much 100 billion that was delivered, of which those two key measures that I talked about, the income tax cuts and the tax incentive for business, was about half of that. So we are talking billions here. There is a very small initiative in there for women, which focuses on some expenditure when it comes to delivering on cadetships in STEM, on internships, on startups, but it's a very small amount. It's 240 million over 5 years. So in the context of how much money has been spent, it does look pretty low in our view. There could have been, I think, more done in that area. The other part, I think, of it, as it probably affects women more, was the lack of any new initiatives on the childcare front. And we know for a lot of households, this probably would have been a more impactful measure had there been further reforms and including further support when it comes to childcare and the cost of childcare than some of the other measures. And a number of clients have said that to us too, that they would have preferred to have seen greater support for childcare and childcare subsidies rather than income tax cuts. So, that was, I think, a bit of a miss. Interesting, and I think it was a little surprising too when we think about some of the measures that were put in place around childcare at the start of pandemic, and clearly how helpful that was. And so the childcare side of things as well for us is one of those measures that you think about in recovery, that it is clearly a measure that if designed properly, absolutely, we know lifts female workforce participation, and that's really key. If you talk to any economist, and they'll tell you the 3 golden Ps are productivity, participation and population. The participation side is important, and you need to provide the foundations to lift workforce participation, including for women. So yes, a little disappointing. I wouldn't be surprised if we saw maybe from opposition leaders' right of reply tonight some discussion around childcare. We know that Labor have tended to put childcare, education, health, they're the kind of priorities. So it'll be interesting to see, I think, whether the opposition have formulated any stronger policy on that front.
Right, thank you. Another question that's come in is, what do you think of the assumptions underpinning the budget?
So the assumptions when it comes to what the government assumes and then formulates both its macro forecasts as well as its budget forecasts, I think the assumptions in the budget were reasonable. I would caveat everything by saying, these are really challenging times, and as economists, and the government is the same as well, the Treasury, you've got to have some baseline case, really, even though it's so uncertain. And so I think the government, which has assumed that state borders remain closed, state borders will open up by the end of this year, with the exception of Western Australia, that international borders are going to take longer, that we probably won't see much movement till the latter part of 2021, that a vaccine is widely available by late 2021. I think they are reasonable assumptions given everything we know. They're not too dissimilar to our own assumptions. And, the government's done the right thing by giving us alternative scenarios as well. If a vaccine came in 6 months earlier, what would that do to confidence, consumption, and overall GDP? Similarly, if there was a setback and another outbreak, what would that do? And I think that's all we can do in this environment. And I think they've done an admirable job of that. I think those assumptions, like I said, are reasonable. If I then take it to their macro forecasts and budget forecasts also reasonable, we would argue that their GDP and employment forecasts are probably a little on the optimistic side. Ours are a bit lower than that, but probably it's understandable. Budgets, and again, I'm on record as saying this, budgets are political documents. I mean, that's just the nature of them. And so, okay, they're a little bit optimistic, but hey, there's a lot of moving parts and there's a lot of uncertainty. So it's not, not wildly so in our view. And again, on that note, the 214 billion deficit that was announced for 2021, we actually think that's a bit conservative. Our own numbers are around 236 billion, so we think there's a risk that we get, an even worse outcome for this year. Now, part of it is we have probably, we're not as optimistic in terms of the macro forecast, but also, as I alluded to in my remarks earlier, we actually think there could be more fiscal measures, including a change in the job seeker payment, and that feeds through to the budget numbers as well. So, yeah, I think the assumptions are reasonable. I think the macro forecasts are a tad optimistic. Doesn't surprise me. Most budget forecasts are kind of err on that side of things. No different to normal, really.
Great. Now this is another one, might also be for you as well, Jen. What about the impact of the budget on securitisation?
Yeah, thanks, Andrea. Hopefully you can see me. So I'd probably make three key observations there, and Su-Lin has touched on these, I think, and also Su-Lin, please jump in if you have any comment to add. But the first one is the budget has had no impact on the TFF, so therefore I would expect a continued dearth of covered bond and RMBS issuance from the ADIs. The other comment I would make is, this is a business-friendly budget with SMEs, the major beneficiary, particularly with the SMEs being entitled to a full upfront write-down of capital assets, eligible capital assets, and the fact that this is available to businesses over, what is it, Su-Lin, the next 2-3 years?
Yep. Sorry. Yep, through to 2022.
So as a result of this, I would expect an increase in origination volumes for lenders in this space, and therefore potentially we'll see an increase in issuance activity with transactions collateralised by these types of assets. The final remark I would make, and Su-Lin, I'm sure you expressed this far more eloquently than I will, but a key feature of the budget has been the tax cuts. And so we see this as potentially tempering some of the household stress that may arise as a result of the reduced government support to households. So this may assist with keeping a lid on arrears and loss performance for RMBS transactions to some degree, but of course this all remains to be seen. Thanks, Andrea.
I think that's really right, Jen. There's no doubt in our mind that the measures in the budget, and I think I alluded to it very much, probably some of them more than we anticipated and earlier. It's been designed to lift now because the government is well aware, I think, of some of those challenges in the first quarter of next year when those key income support payments end, and also as the deferral periods end as well. And so, the aim is to get in early and hopefully temper some of the impact of that in Q1. So I think that's very much the case, and hopefully that as well tempers the lift in arrears. I think that when it comes to how much businesses will spend and how much they take up, and that feeds through to potentially the securitisation side, confidence is really key here. And that's why I think this budget has been quite well designed, and that measure too. It does go all the way to 2022. It gives, I think, businesses time to make those decisions. They don't have to make them right now. We know when earlier in the piece, when the instant asset write-down came and had a deadline of June 30th, that there was a big rush in the last month, and we saw that particularly through vehicle purchases. And so the fact that this is a longer scheme, available for some time, I think is part of the design deliberately, and the key will remain confidence for sure. And if those confidence numbers lift and they hold up higher, that's what will get businesses to invest, and obviously higher as well. But that investment side is pretty key, and a big incentive will help, but businesses still have to be confident even with that incentive there. So that's what we're watching out for. We are hopeful on that front, and that will have, I think, broader implications.
Thank you. I think we've got time just for one last question. There's significant emphasis for employment on large infrastructure projects. Given the long lead time in commencing and ramping up big infrastructure projects and 90% underspend in the current year, do you think that the employment impact assumptions are too high?
So I do think the labour market forecasts are on the optimistic side, and that partly stems from GDP forecasts that are a bit on the optimistic side, but it's more that than specifically the infrastructure piece. When we look at the amount of spending on infrastructure in the budget, it's actually pretty modest. It's only an additional 10 billion over the 4 years. So very modest in the scheme of things. There are no big ticket items either. You know, sometimes there's a big flagship one. Most of it, if you looked at it, and I did look at it, it's like, you know, it's a road in wherever and another road in somewhere else, plus a safety campaign. So it's, you know, pretty run-of-the-mill type infra. And so from that perspective, I don't think it materially shifts the dial in terms of the labour market discussion. What's more important really is, you know, whether I think all the measures that are put in there lift activity and generate more broad-based employment generation, helped as well by specific measures around, as I was discussing, apprentices and young Australians. So I think that's more of the issue rather than the pure infrastructure piece, which, like I said, was pretty modest.
Excellent. All right, well, I'm mindful of time, so I think I'd just like to thank you very much, Su-Lin, for your time today. And for sharing those insights with us. Certainly interesting times. Thank you also, Jen, as well. Also, I'd like to thank everybody for dialing in or Zooming in today. Before we go, though, I'd like to, Women in Securitisation would just like to ask you to participate in a quick poll. Given the times we're living in, we've been looking for ways to help women in securitisation to connect. If we were to hold a regular sort of coffee break Zoom meeting, what we're wanting to know is, would that be something that would be of interest to you? So if you could just let us know via the poll, I'll keep that open for a minute or so. Okay, well, I think we can wrap things up. As I say, I'll keep the poll open for a little bit longer. Thank you again, Su-Lin. Thank you, Jen, and thanks everybody for attending. Thank you.